Tokenize, let's innovate, bringing answers to the digital state. From finance to games, we're redefining, connecting the dots, the future is shining.
So, first off, I am Josh Lawler. A lot of you guys know me. I have to say that the idea of following Bruce Fenton is just kind of ridiculously silly. My gosh, just Bruce, amazing, super inspiring, and just cannot possibly hear you enough. And I say that to almost no one, so thank you. Okay, so with that said, we are at the Institutional Adoption Are We Here Yet panel. We've got a couple of esteemed colleagues who candidly can do a much better job introducing themselves than I can. So Jake, why don't you go ahead and then we'll...
Yeah, so I've been in this space about 13 years now. I'm a serial entrepreneur, made several exits. Most recently, I sold my company Height Zero to BitGo and then took over the head of ecosystem role. So we onboard new coin protocols, labs, entities, foundations, deliver them the stack of services that BitGo has to offer. And yeah, I'm really excited about this position because I think BitGo specifically is so well positioned in the marketplace and has such a front row seat to everything happening in crypto. So it creates a lot of very interesting opportunities and a lot of discovery on what's being built and who are the builders in this space.
Okay, John?
Hi, everyone.
It is off.
There we go. Hi, everyone. My name is John D'Agostino. I am head of strategy at Coinbase Institutional. I used to be head of strategy for the New York Mercantile Exchange, which at the time was the largest commodities exchange in the world, the commodity derivatives exchange in the world. I then took some time off and I traded derivatives. I'm an adjunct at MIT, and I'm on the board of directors of AMA. So I work a lot. AMA is about 9,000 hedge fund lobbying group, working group. So for Coinbase, I do a lot of different things, from policy to new product design to helping this sales team get very, very large institutional clients, whether it be it large asset managers, owners like insurance pools, over the hump of buying their first, making their first allocation to digital assets. Was involved at the BlackRock ETF and just kind of peppered throughout the organization.
Right on, and I guess I shortcut my own introduction. I am Josh Lawler. I'm a partner at the law firm Zuber Lawler, where we practice a lot of commercial intellectual property law, a lot dealing with technology, personally doing a lot of mergers and acquisitions, finance, and of course distributed ledger technology regulation, agentic artificial intelligence regulation. With that said, institutional adoption, are we there yet? I think maybe I want to start with drawing kind of a dichotomy. We have institutions right now, BitGo and Coinbase being two of them, that are institutions, but possibly not what most people are thinking of when they use the word. But certainly they're getting big enough that they're kind of moving the needle. So in terms of how BitGo might think of something, for instance, compared to how JP Chase might think of something, I mean, how do you think the ecosystem differs there?
Yeah, there's definitely a question of scale here. And like obviously with us two up on stage, we're talking about hundreds of billions of dollars of assets under custody between our two firms. And that is largely institutionally driven. So already that's a pretty significant amount of institutional adoption. But just like everything else in this space, I think it scales. So right now, a lot of these institutions are much smaller. A lot of VCs. I mean, we're starting to see some of those larger institutions come into BitGo, and I'm sure Coinbase is seeing the same. And that's really how this starts getting much larger, much faster. And you talk about JP Morgan, for example. I'm sure both of us are in conversations with them and many other large banks, and that is really the next stepping stone into like what is the largest institutions in the financial asset space.
Yeah, so I think I made the mistake of speaking at a conference early in my tenure at Coinbase, and the CEO saw me and he likes how I speak. So I do these a lot. It's pretty much my job these days. And the most common panel, I guess, to ask to be on is some permutation of when will institutions come. And it's curious to me because I was head of strategy of the largest commodities exchange in the world, and we are where the NYMEX was in 2008. So my answer to this is it is institutional. It's phenomenally institutional. And my job at NYMEX was to sit in a room with the quants and create new options contracts that could replicate certain risks that was being traded OTC. And I failed more often than I succeeded. If I could have the success record of this asset class back then, I'd be sitting on an island right now. So I'm not saying we shouldn't stop dreaming, but I think we should congratulate ourselves to some degree, right? It is still a volatile, idiosyncratic asset class that's prone to gaps up and down in pricing. So that makes it difficult for it to be above 10, 15% of any institutional portfolio. But the fact that it is low to medium single digits, that is higher than most allocations to commodity derivatives, to crude oil derivatives. So, and this asset class in modern form is what, 7 years old in terms of like a real infrastructure? That is insane. That's incredibly good. One other quick story. I hate that Polymarket's so successful. I mean, I love it. It's wonderful for them. But I tried to create that 20 years ago. My first newly minted Harvard MBA, got to the NYMEX, and I built a parimutuel system, which is horse-tracked math, to use futures to bet on the closing price of the S&P. Because like, oh, all these traders will love this. And it was elegant and beautiful, mathematically perfect. Fucking failed miserably. And I struggled with that for years. I realized I had about 75 to 125,000 Bloomberg screens I could push a new product to. There's millions of people with phones you can push that product to. So I suffer from just a lack of scale. So that is incredibly profound. That all the Bitcoin ETF was by far the single, and with all due respect, it is the most democratized product because it's not owned by a few people. It may be controlled by or issued by a few organizations, but anyone in the world can buy it. So it is an institutional asset class. We should almost stop telling people when institutional because that implies it's not ready.
All right, so I'm going to put a peg in the control versus participation point, which is a huge one, which we'll get to later because it's super interesting. But I want to run a little bit of like a thought experiment. You said in your introduction that you spend a lot of time trying to get institutions over the hump to buying their first digital asset. And I'd kind of like to see what that looks like. I mean, here I am. I'm an institution. I'm a 150-year-old, nobody's ever heard of it because it's a white shoe institution. And I'm sitting here going, I've heard about this Bitcoin thing. Should I buy a Bitcoin? Why would I do that? It seems like a scam.
You want to? Sorry.
Yeah, so at my prior company, Zerion, we had a wealth management offering. So we were trying to convince financial advisors to start trading digital assets on behalf of their clients. So we dealt with this a lot, where we'd get a phone call and they're like, I did a Zoom call with my client and walked them through opening a Coinbase account and had them buy some BTC that way. And like now I'm trying to figure out how I can bill on that. And we're like, well, first of all, don't do what you're doing and use us as a solution, because as soon as you could convince a financial advisor and they have a means to start billing on this thing, then they have the incentive to go out there and go after their clients and start getting them onto this higher margin opportunity for them. Because ultimately, pretty much everybody in financial services, they care most about their own bottom line. And so if you can incentivize them, then they'll get their clients on. And so that was a pretty successful model for us. Granted, the financial advisory space is a very long sales cycle, no matter what, right? Like brutal. And so we started to learn that early in our business, and that's why we bifurcated to another product and went in the token management direction, which is like grant and warrant equity compensation type model. But still, it was very interesting because pretty much no pitch went badly, because they're all already hearing about this. They're already receiving questions from their clients. They just have no idea what to do about it.
Yeah, so I think of it fairly simply and maybe somewhat cynically. There's two basic types of pools of capital. There's fiduciary and non-fiduciary pools of capital. So fiduciary pools of capital have somebody else they have to answer to, and non-fiduciary could be family offices, could be, I put governments in that space, sovereign wealth funds. So for fiduciary pools of capital...
Hold on, I have to stop.
Yeah.
The governments have no one to answer for. I just want to make sure that I heard that clearly. Where is Bruce when you need him?
So cynically, that's how they act.
I understand.
So if I'm speaking, if I'm selling a fiduciary pool of capital, whether it's a hedge fund or anything else, on getting to the asset class, I don't try to sell them on the underlying value proposition. I show them the alpha potential that exists in a still relatively opaque market. That's all the negative things I said before that make it harder for retail. That's what alpha producers love. So when you see polls that say 90% of hedge funds are looking into crypto, take it with a grain of salt. Like, that's their job. If I'm an investor in a hedge fund and they're not examining a new asset class to produce alpha, when like 97% of hedge funds, they haven't beaten the S&P in 15 years, I'm redeeming. So I fully expect more than half of fiduciary pools of capital to trade this asset class because they have no choice. Because other asset classes are boring. For non-fiduciary, I guess the best little quick story I can give you is I was speaking, I won't say who, but I was speaking to a politician who's kind of neutral to negative on crypto, not one of the zealots, but just old school finance guy and just, I don't get it and whatnot. And so I had 10 minutes with him. I'm like, look, I'm not going to try to sell you on the value proposition. I said, just if you can go back in a time machine 75 years and you can say to government, hey, I know nobody thinks that semiconductor fabrication is going to be important because, who cares about computers? But maybe we don't let all of it, just in case we're wrong, maybe all of it's not built on a tiny island of stone's throw from China. And he laughed and said, yeah, that's probably would have been a good idea. Great. So XYZ name, what if you're wrong about this? And that's what I would say to large non-fiduciary pools. Like you have to acknowledge the zeitgeist is there. So don't miss this trade. Like learn, educate yourself with a de minimis basis point position, and then eventually grow. Now, the last thing I'll say is this: not every pool of capital will want to hold this asset. I know that's sacrilege to say, but not everyone wants to own every type of risk. And it's okay. They're not idiots. They're not Luddites. One problem we do, one mistake we make, is we go into big pools like pensions and say, oh, you need to own this because it's idiosyncratic. It can go up 10,000%. The problem with that argument is, A, they don't buy lottery tickets. That's not how Texas teachers invest. So you lose the argument there. Second, if they were going to buy a lottery ticket, there's other things they can do that don't have the hair of crypto. About upside calls, you can have early stage venture. So we got to get comfortable with the fact that, at least for now, not everyone's going to invest, and that's okay. The key is just improving the infrastructure so you can go from a 50 basis point to 4-6% position.
So back to your conversation with that politician. So you're telling him, imagine if you might be wrong, right? I mean, isn't the argument now you're already wrong?
Yeah, no, that's fair.
Because you do really well telling politicians they're already wrong, by the way.
Make friends that influence people. Like you've got to read the room. So I don't think he was in a position. Maybe that's the right tone sometimes. I agree. I chose a softer sell approach.
Okay, so in terms of how you guys are advising, we've got a giant continuum of risk-based assets that are now digital assets. And it's one of those things, like calling something a digital asset is almost like saying it's an asset that's printed on paper. I mean, it really doesn't matter that it's digital. There are all kinds of different things. And how are you guys seeing things in terms of the range of adoption where, Bitcoin, obviously, it's the oldest, it's the most stable, it's the most steady, possible certain stable coins, aside. And then you've got all the way down to, the meme coin world with, utility tokens somewhere in between, plus the other element, which is that these things can obviously be more than one thing at a time. You can have a use case which has financial value also, which I would argue every gas token fits into that category. It derives its values presumably based on supply and demand, even though sentiment seems to be making a massive piece into it. Like, how do you navigate that when you're talking with somebody who's got, the types of responsibilities that your clients have?
Well, to me, it's blue chips and what is largely traded like tech stocks, because that's what a lot of these ecosystem, these L1s, these L2s, that's what they're building. They're building technology, they're building applications, and really they're being traded very similarly to that. So that's often how I pitch the broader ecosystem of crypto. And then outside of that, BTC continues to be king. I mean, we're talking about a $3 trillion market, of which $2 trillion is one asset. And so that is the most obvious gateway into this space. And then what we found to be really interesting, and it's happening more and more than ever before, is you start getting some of these very large allocations that come in through BitGo, through Coinbase, and then the next thing they ask is, okay, well, how do I earn yield on this? Like, it's pretty much immediate. Like, the greed comes in immediately. And we need to continue to move away from being just a passive asset class if we want to get more and more large institutions in. And there's been a lot of players that are starting to unlock this, like CoreDAO, so that you could stake your BTC without it ever leaving custody. Same with Babylon, and these are yield-generating opportunities, not yet being paid in native BTC, which is part of the problem. But like outside of that, it starts getting very interesting on the DeFi side. And you have vaults, you have liquidity pools, you have ways to lend out your BTC, earn native yield, and do it in a pretty safe and decentralized or permissionless manner. And so I think that is going to start being very interesting as institutions continue to adopt and continue to allocate larger and larger positions in BTC, because they're going to need that yield opportunity.
I agree with that. I don't have a better way of thinking about it. And most of the people I speak to are fiduciary asset managers. They don't need my advice about what to buy and sell. But I do find it interesting. I don't get some of the hatred towards meme coins. I don't engage in them. I wouldn't recommend them. But I find it interesting that like a group of people who tend to skew libertarian suddenly want to tell people what they can and cannot buy. So I look, as long as everyone knows it's BS, as long as everyone knows it's held predominantly by the I don't, if people want to waste, I go fishing, I never catch anything. I waste my money doing that. If people want to do that, let them do it. I don't have a problem with that.
You raise a very, very interesting point. I've kind of postulated the thought experiment to people, like, what do you do as a regulator? And I'm a lawyer. This is what I do. What do you do as a regulator when you can tell somebody to make all the disclosures that say this thing is not a financial product, has no value whatsoever, but nobody on the entire planet believes them?
Look, 62% of stocks on the New York Stock Exchange have negative EBITDA. What are they trading on? They're trading on pure momentum. Upside natural gas calls. The natural gas is trading about 322 in MMBTU. You can buy $100 upside natural gas calls. That's just vapor. And that's a multi-billion-dollar market. So I don't want to say I'm recommending these as investments, but there's a difference between, there's a certain hypocrisy applied to crypto. So FTX, complete disaster, right? What are the net losses from FTX?
No, they got lucky though.
Right. But my point is, in the same 12-month period, we've all heard of FTX, and FTX, called into question the integrity of crypto. Anyone hear of what happened to the LME and nickel? The LME, the London Metals Exchange, canceled $14 billion of nickel trades because if they would have settled those trades, the market would have inverted and everyone would have gone bankrupt. Okay. If you were on the other side of that, if you expected to make money off of your trade, woke up and the LME said, sorry, those trades are all decayed, all killed, you were robbed. There's no economic difference at all.
Totally.
But are we having a discussion about the integrity of the commodities market?
Occasionally, but yeah, not usually. I've been watching that in silver for decades.
You understand, and as an attorney, you also know that less than 8 months later, the UK courts, because Citadel sued for $800 million, the UK court said, nope, they're sacrosanct, LME can do whatever it wants, threw all the cases out. So there is a level of hypocrisy around what happens in crypto versus TradFi.
Totally. That's fair.
I like Bruce's comment. There's bullshit everywhere.
There's bullshit everywhere.
Yeah.
There's bullshit everywhere. Okay, fair enough. Sorry, I'm not cogitating. You stumped me for 1 second. Okay. I wanted to get back to the meme thing, but I'm trying to remember exactly where I got that. I mean, never mind. Different topic. So centralized versus decentralized trading. You just mentioned DeFi. Most of what I kind of am observing these days is that the two are running in parallel. They're both seemingly accepted. Do you think it stays that way? Do you think that potentially the decentralized model maybe starts asserting some hegemony at some point? Because it's a lot cheaper, for sure. What are your thoughts?
I do think we'll get to a point where it's done on a much broader scale, and I think we need to get to that point also. I mean, it's part. I mean, we're both two very centralized companies up here, and this is me saying this.
Not lost on me.
But I've been in the space for a long time, and that's just. It's been a technical blocker for a long time where it's just not as efficient. Liquidity is not as deep. It's starting to get better once again, but I mean, there was a huge lull for a period of time where DEXs were just basically swap products, right? And now we're getting to a point where things like Hyperledger are able to, or Hyperliquid, excuse me, not Hyperledger, bless you. Hyperliquid we're starting to see some serious volumes there and some serious liquidity. But again, this comes back to, if you want large institutional players to play around in any of this space, the liquidity needs to be very deep. The depth of market needs to be very deep, and it's just not there yet. So for now, it's really, I see DeFi as like, there's probably about $300 million of retail DeFi users that just gets washed through everything. Once we start seeing real institutions play in this space, we're going from hundreds of millions to tens or hundreds of billions, and it will completely change the landscape of that space. But, I mean, we're up here talking, hoping that we can get some of these large institutions just to buy BTC, right? And then potentially sell them on other yield-generating opportunities. Like, we're decentralized finance, and just the further you go down that stack, and I really think, like, decentralized perp exchanges is pretty far down that stack, and I think we're still 5 to 10 years from that getting to true institutional volumes. But I do think it's coming.
I'm going to take a second and point out that the views of the participants are solely their own, not the views of their organizations.
Correct.
And okay, with that said, John, please.
Yeah, no, look, again, not only am I work for a centralized firm, I've always worked for, I love exchanges. I chose, very odd for a Harvard Business School graduate to go work for the NYMEX. It's like going to work for the post office. But I thought it would be a better education to be at the epicenter of liquidity than to go work for an investment bank. So I find them fascinating institutions. DeFi is awesome. DeFi is not new, by the way. We have what's called the OTC market forever. That's DeFi. And it tends to dwarf the listed market. A couple problems with the OTC or DeFi markets is if you don't have good insight into the level of the order book, you mentioned depth of market. Depth of market's great. Equally important is breadth of market. I learned this as a kid. There was this horrible thing called Hurricane Katrina that evacuated the city of Houston in 2002. And the natural gas market was very deep. But we found out that day that Houston was evacuated, it was not very wide because there were about 12 hedge funds in Houston that were 80% of the volume. And the entire natural gas market just seized up. So when you don't get to see that, with centralized exchange you can. And then in terms of centralization versus not, the characteristic of decentralized ability is essential to crypto. But the one thing I will say about self-custody versus not, be very honest. How many, raise your hand, if God forbid something were to happen to you, how many of you have someone in your life with both the technical skill and the absolute trust that if you were to pass away today, they could take a hard bearer ledger asset and know what to do with it, sell it, and move it to your family? Keep your hands up. Is it your lawyer? No. Okay, great. That's about.
It should be your lawyer.
For this crowd, but let's be fair. This crowd, it was only about 30 to 40%. Typically, I ask that question, it's less than two people in the crowd.
This crowd should be 100% for what it's worth.
That's a problem, right? So I think it has to have the option to do it, and great on you. But I think the majority of people over time will answer no to that question, and so therefore, I like having a centralized option.
Go unwind your Dolomite position and bear a chain. Like, leave that with your wife and see how that goes.
Okay. Well, we're running kind of short on time, and me being the lawyer, I haven't really asked too much in the regulatory. We've got a newly open administration in the United States. That's at least as near as I can tell, making things much easier in terms of anybody doing almost anything they want, which candidly scares the living crap out of me. What do you see as far as that? How's BitGo kind of experienced the new administration, and how are you looking at things? And then same question for Coinbase. Yeah,
we're obviously very close to the administration, and it's been pretty beneficial to us and the direction that we're growing. But I still think there's a lot of good that's come. All the cases being dropped, feels like a much more free market is developing. But we've yet to see some tangible guidelines, tangible rails that we can start building with. I mean, I've been told by a couple of regulators that I speak with that the staking ETF clarity is coming, and I think that's going to be very interesting because right now with staking, with LSTs, nobody really knows whether or not it's a security. There's this game that we've all been playing for 10 years in this space.
Came out this morning. The SEC said it's not security.
I was out a little bit late, so.
Yeah. By the way, they also dropped the case against Binance US and CZ last night, if anybody didn't notice that.
Yeah, look, short answer, it's insane how things have moved. I think the thing I think about is how durable and persistent is this? Because administrations change, executive orders can be outdone by other executive orders. So I do think the one thing that is durable, at least for the next 10 to 15 years, is I think it's unlikely a politician will run an anti-crypto agenda.
Never again. The money's not there.
It makes no sense because I don't know a single. I know Nouriel Roubini is a very close personal friend, and I respect him. But as virulently anti-crypto as he is, he doesn't vote on that issue. They didn't pick up a single vote by being anti-crypto, where the pro-crypto people could have picked up 52 million. So I think, money aside, I think they're smart, they're savvy. There's no benefit to running on anti-crypto.
Yeah, well, I will guess maybe end on a very non-legal point, which I've noticed though, which is that the technology always wins.
Of course it does.
Thanks, guys.
Thank you.
Appreciate it.
Thank you.
Tokenize, let's innovate, bringing assets to the digital state. From finance to games, we're redefining, connecting the dots, the future is shining.